Question 1. Scenario-based. Mr. Thompson is the Chief Risk Officer at Blue Ridge Insurance. He's reviewing their current reinsurance program to manage potential catastrophic risks. The company is considering entering into a new treaty with a reinsurer to cover significant losses from natural disasters like hurricanes and earthquakes. However, Mr. Thompson is concerned about the financial stability of the reinsurer and its ability to pay claims in event of a disaster. Which action should Mr. Thompson prioritize to ensure that Blue Ridge Insurance is protected from counterparty risk in this scenario? A. Verify that the reinsurer is listed as an approved reinsurer in the NAIC's quarterly financial reports. B. Focus solely on the reinsurer's proposed premium rates and negotiate the lowest cost possible. C. Choose reinsurer that offers flexible contract terms even if they are unrated by any financial authority. D. Ensure the reinsurance contract includes an exclusion clause for high-severity events like hurricanes to limit Answer A. Verify that the reinsurer is listed as an approved reinsurer in the NAIC's quarterly financial reports. Explanation. The National Association of Insurance Commissioners (NAIC) provides detailed financial solvency reports on reinsurers. Ensuring the reinsurer is listed as an approved reinsurer minimizes counterparty risk, as these companies meet stringent financial and solvency requirements. Focusing on premium rates option without considering the reinsurer's stability can expose the insurer to significant risk. Selecting reinsurer that is unrated option C increases uncertainty. Excluding high-severity events option D would defeat the purpose of catastrophic risk coverage. Kentucky regulations emphasize financial solvency to protect policyholders from potential defaults by reinsurers. Question 2. Which of the following best describes the primary difference between quota share and excessive loss reinsurance treaties? A. Quota share covers all losses up to a certain percentage, while excessive loss only covers losses beyond a predetermined amount. B. Excessive loss applies to both proportional and non-proportional treaties, while quota share is exclusively non-proportional. C. Quota share requires reinsurers to pay claims on a per-claim basis, while excessive loss covers aggregate losses over a period. D. Excessive loss allows the ceding company to retain more risk, while quota share limits the company's retained risk to minimum level. Answer A. Quota share covers all losses up to a certain percentage, while excessive loss only covers losses beyond a predetermined amount. Explanation. In quota share reinsurance, the reinsurer agrees to take on a fixed percentage of both premiums and losses from the ceding insurer. In contrast, excessive loss reinsurance only provides coverage for losses that exceed a predetermined threshold, protecting the insurer from high-severity, low-free losses. Option B is incorrect because quota share is a type of proportional reinsurance, while excessive loss is non-proportional. Option C mischaracterizes how claims are handled under both treaties. Option D incorrectly implies that quota share always limits retained risk, which varies by contract terms. Question 3. Under Kentucky's reinsurance regulations, what is key requirement for reinsurance broker operating within the state? A. The broker must file an annual financial statement with the Kentucky Department of Insurance. B. The broker must ensure that all reinsurance contracts include an arbitration clause for dispute resolution. C. The broker must hold valid license issued by the Kentucky Department of Insurance and meet continuing education requirements. D. The broker must be member of the National Reinsurance Brokers Association (NRBA) to operate Kentucky. Answer C. The broker must hold a valid license issued by the Kentucky Department of Insurance and meet continuing education requirements. Explanation. In Kentucky reinsurance, brokers are required to hold a valid insurance producer license issued by the Kentucky Department of Insurance. They must also meet continuing education requirements to maintain their license. Filing financial statements option A is a requirement for reinsurers, not brokers, while including an arbitration clause. Option B is a common practice in reinsurance contracts. It is not a licensing requirement for brokers. Membership in the National Reinsurance Brokers Association. Option D is not mandated by Kentucky law. Question 4. Scenario-based. M.S. Jefferson, a reinsurance underwriter at Derby Mutual Re, is evaluating a surplus share reinsurance treaty proposal from a primary insurer. The proposal outlines that the reinsurer will cover all risks exceeding $500,000 up to a maximum retention limit. The insurer's book of business includes policies ranging from $100,000 to $2 million in value. M.S. Jefferson must decide whether to accept this treaty based on the risks it presents. Which of the following should MS Jefferson focus on when assessing the insurer's portfolio under this treaty? A. The number of policies that exceed the $500,000 retention limit. B. The average policy size in the insurer's portfolio. C. The frequency of claims on policies below the retention limit. D. The insurer's expense ratio and profitability trends. Answer A. The number of policies that exceed the $500,000 retention limit. Explanation. In a surplus share reinsurance treaty, the reinsurer is responsible for covering the portion of risk exceeding the ceding insurer's retention limit. MS Jefferson must assess the volume and distribution of risks that exceed $500,000 to understand the reinsurer's exposure, while the average policy size, option B, and claim frequency on lower value policies, option C, are useful data points, they are less critical in this context. The insurer's expense ratio, option D, is relevant to financial stability but not directly tied to surplus share risk exposure. Question 5. In excess of loss reinsurance, which of the following best describes the role of the priority attachment point? A. The priority is the maximum amount the reinsurer will pay for a claim. B. The priority is the portion of the loss that the ceding insurer retains before the reinsurer's coverage begins. C. The priority is the percentage of premiums paid by the ceding insurer to the reinsurer. D. The priority is the minimum premium required to activate the reinsurance contract. Answer B. The priority is the portion of the loss that the ceding insurer retains before the reinsurer's coverage begins. Explanation. In excess of loss reinsurance, the priority, also known as the attachment point, is the threshold amount that the ceding insurer must pay before the reinsurer's coverage kicks in. For example, if the attachment point is $1 million, the insurer is responsible for all losses up to that amount. Option confuses the priority with the limit of liability. Options C and D are incorrect as they relate to premium arrangements, not the attachment point. Question 6. Which of the following statements about catastrophe bonds is true? A. Catastrophe bonds are issued by reinsurers to protect them from operational losses. B. Investors in catastrophe bonds assume the risk of a specified catastrophe event occurring. C. Catastrophe bonds provide unlimited coverage for all types of insurance claims. D. Catastrophe bonds must be backed by the state guarantee fund to be valid. Answer B. Investors in catastrophe bonds assume the risk of a specified catastrophe event occurring. Explanation. Catastrophe bonds are a form of insurance-linked securities deals that transfer the risk of catastrophic events to investors. If a specified catastrophe, e.g. a hurricane or earthquake, occurs, the bondholders may lose part or all of their investment, which is then used to pay insurance claims. Option is incorrect because catastrophe bonds protect insurers, not reinsurers. Option C is incorrect because coverage is limited to specific, predefined events. Option D is false as catastrophe bonds are privately issued financial instruments and are not backed by state guarantee funds. Question 7. According to Kentucky's solvency regulations for reinsurers, what is key requirement that reinsurer must meet to be considered admitted in the state? A. The reinsurer must maintain minimum capital of $10 million in the United States. B. The reinsurer must provide collateral equal to 100% of its assumed liabilities. C. The reinsurer must be licensed and domiciled in Kentucky. D. The reinsurer must be approved by the NAIC and meet Kentucky's financial solvency standards. Answer D. The reinsurer must be approved by the NAIC and meet Kentucky's financial solvency standards. Explanation. To be considered admitted in Kentucky, reinsurer must be approved by the NAIC and meet the state's financial solvency standards. These requirements ensure that the reinsurer is financially stable and capable of meeting its obligations. Option is incorrect because there is no blanket $10 million requirement across all states. Option B applies to non-admitted reinsurers. Option C is incorrect because reinsurers can be domiciled outside of Kentucky and still be admitted. Question 8. Which of the following best describes the difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance covers specific risks while treaty reinsurance covers all risks within the portfolio. B. Facultative reinsurance requires a low premium than treaty reinsurance. C. Treaty reinsurance is always proportional while facultative reinsurance is always non-proportional. D. Facultative reinsurance automatically renews while treaty reinsurance does not. Answer A. Facultative reinsurance covers specific risks, while treaty reinsurance covers all risks within a portfolio. Explanation. Facultative reinsurance is used to reinsure individual risks that the ceding company chooses to submit for reinsurance, while treaty reinsurance covers all risks within a specific category or portfolio under a pre-agreed agreement. Option B is incorrect as premiums depend on risk factors, not the reinsurance type. Option C is incorrect because both facultative and treaty reinsurance can be proportional or non-proportional. Option D is false because neither type of reinsurance automatically renews without a new agreement. Question 9. Which of the following is a key benefit of stop-loss reinsurance? A. It provides protection for a single large claim. B. It limits the reinsurer's exposure to cumulative losses within specified period. C. It allows the ceding insurer to transfer all risk to the reinsurer. D. It guarantees the ceding insurer minimum profit margin. Answer. B. It limits the reinsurer's exposure to cumulative losses within specified period. Explanation. Stop-loss reinsurance is non-proportional reinsurance arrangement that protects the ceding insurer from cumulative losses exceeding specified threshold within policy period. It is designed to cover aggregate losses rather than individual claims. Option describes excessive loss reinsurance. Option C is incorrect because ceding insurers retain some risk. Option D is false as no reinsurance contract guarantees profit margins. Question 10. Under Kentucky law, which of the following is a requirement for a non-admitted reinsurer to transact business with a licensed insurer in the state? A. The reinsurer must be a member of the Kentucky Reinsurance Association. B. The reinsurer must maintain a trust fund in the United States. C. The reinsurer must only provide proportional reinsurance contracts. D. The reinsurer must file quarterly reports with the Kentucky Department of Insurance. Answer. B. The reinsurer must maintain a trust fund in the United States. Explanation. Under Kentucky's regulations, non-admitted reinsurers must maintain trust fund in the U.S. to ensure their financial obligations to U.S. policyholders are met. This trust fund is safeguard for credit for reinsurance purposes. Options and C are not state requirements. Option D is requirement for admitted reinsurers, not non-admitted ones. Question 11 scenario-based. Mr. Blake, an insurance broker in Kentucky, is negotiating a quota share treaty for a small insurer. The treaty terms propose that the reinsurer will take 40% of each risk and receive 40% of the premium. During the negotiation, Mr. Blake learns that the insurer has a history of high-frequency, low-severity claims. Based on these facts, what should Mr. Blake recommend to the insurer? A. Accept the quota share treaty as proposed to stabilize the insurer's premium income. B. Recommend a surplus share treaty to limit the reinsurer's exposure to smaller risks. C. Decline the quota share treaty and seek an excessive loss reinsurance arrangement. D. Negotiate for the reinsurer to take higher percentage of premium to compensate for the high claim frequency. Answer. C. Decline the quota share treaty and seek an excessive loss reinsurance arrangement. Explanation. Given the insurer's high-frequency, low-severity claims history, a quota share treaty may not be ideal. The insurer would benefit more from an excessive loss reinsurance arrangement, which protects against high-severity losses rather than spreading out low-severity risks. Quota share is better suited for insurers with balanced or stable risk profiles. Surplus share, option B, would help limit smaller risks, but it doesn't address the high claim frequency issue effectively. Question 12. Which of the following is true about the follow the fortunes doctrine in reinsurance? A. The reinsurer must follow all underwriting decisions made by the ceding insurer without question. B. The reinsurer must indemnify the ceding insurer for all claims regardless of whether they are covered under the reinsurance contract. C. The reinsurer must honor claim settlements made by the ceding insurer provided they are made in good faith and within the terms of the original policy. D. The reinsurer must adjust its premium rates on the ceding insurer's claim history. Answer. C. The reinsurer must honor claim settlements made by the ceding insurer provided they are made in good faith and within the terms of the original policy. Explanation. The follow the fortunes doctrine ensures that the reinsurer honors the ceding insurer's claim settlements as long as they are reasonable, made in good faith, and within the terms of the original insurance policy. This doctrine promotes trust and cooperation between the parties. Options and B are incorrect because the reinsurer is not obligated to follow decisions that are outside the terms of the contract. Option D is unrelated to the doctrine. Question 13. In Kentucky, which of the following is a requirement for reinsurance brokers operating in the state? A. They must hold a reinsurance broker license issued by the Kentucky Department of Insurance. B. It must post a performance bond equal to 10% of their commissions. C. It must be a resident of Kentucky to conduct business in the state. D. It must submit monthly reports on all transactions to the Kentucky Department of Insurance. Answer A. It must hold a reinsurance broker license issued by the Kentucky Department of Insurance. Explanation. In Kentucky, reinsurance brokers are required to obtain a license from the Kentucky Department of Insurance to operate legally. There is no requirement for brokers to post a performance bond or be residents of the state. Reporting requirements are quarterly or annual, not monthly. Question 14. Which type of reinsurance arrangement is designed to protect an insurer from cumulative losses over a specified period rather than individual claims? A. Proportional reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Facultative reinsurance. Answer C. Stop loss reinsurance. Explanation. Stop loss reinsurance is a type of non-proportional reinsurance that provides coverage when the ceding insurer's cumulative losses exceed predetermined threshold during policy period. It protects insurers from aggregate losses, unlike excessive loss reinsurance, which applies to individual claims. Question 15. A Kentucky-based insurer enters into a treaty reinsurance contract with a reinsurer. Which of the following best describes the reinsurer's obligations under the contract? A. The reinsurer can choose which individual risks to accept. B. The reinsurer must cover all risks within the treaty scope regardless of individual underwriting decisions. C. The reinsurer only covers risks if the insurer's solvency ratio falls below a certain level. D. The reinsurer is not obligated to pay claims unless the insurer provides collateral. Answer B. The reinsurer must cover all risks within the treaty's scope regardless of individual underwriting decisions. Explanation. In treaty reinsurance agreement, the reinsurer agrees to accept all risks that fall within the parameters of the treaty. Unlike facultative reinsurance, the reinsurer does not evaluate each individual risk separately. Question 16. Which of the following would be considered a proportional reinsurance agreement? A. Stop loss reinsurance. B. Quota share reinsurance. C. Catastrophe bond. D. Excessive loss reinsurance. Answer B. Quota share reinsurance. Explanation. Quota share reinsurance is a proportional reinsurance agreement where both premiums and losses are shared between the ceding insurer and the reinsurer in a fixed percentage. In contrast, excessive loss and stop loss are non-proportional. Question 17. What is the primary purpose of collateral requirements for non-admitted reinsurers in Kentucky? A. To ensure compliance with Kentucky's premium tax regulations. B. To secure the reinsurer's obligations in the event of insolvency. C. To guarantee minimum return on investment for the ceding insurer. D. To reduce the reinsurer's administrative costs. Answer B. To secure the reinsurer's obligations in the event of insolvency. Explanation. Non-admitted reinsurers must provide collateral to ensure that they can meet their financial obligations to ceding insurers in case they become insolvent. The collateral protects the ceding insurer's policyholders. Question 18. Under Kentucky law, a ceding insurer can receive credit for reinsurance if the reinsurer meets which of the following conditions? A. The reinsurer must be a member of the Kentucky Insurance Guarantee Association. B. The reinsurer must maintain a trust fund in the U.S. C. The reinsurer must provide surplus relief to the ceding insurer. D. The reinsurer must assume all liability for the ceding insurer's claims. Answer B. The reinsurer must maintain a trust fund in the U.S. Explanation. To receive credit for reinsurance, non-admitted reinsurers must establish a trust fund in the U.S. to ensure that funds are available to cover claims obligations. Question 19. Which of the following types of reinsurance contracts would best protect an insurer from high-severity, low-frequency events? A. Quota share reinsurance. B. Facultative reinsurance. C. Catastrophe reinsurance. D. Surplus share reinsurance. Answer C. Catastrophe reinsurance. Explanation. Catastrophe reinsurance is specifically designed to protect insurers from high-severity, low-frequency events such as natural disasters. It provides coverage once losses exceed a pre-agreed threshold. Question 20. A reinsurer in Kentucky wants to write facultative reinsurance for a single large commercial risk. Which of the following is true about this type of reinsurance? A. The reinsurer automatically covers all risks in a portfolio. B. The reinsurer must assess and approve the specific risk before agreeing to provide coverage. C. The reinsurer must accept the risk based on the terms of the treaty. D. The reinsurer cannot decline any risks presented by the ceding insurer. Answer: B. The reinsurer must assess and approve the specific risk before agreeing to provide coverage. Explanation: in facultative reinsurance, the reinsurer evaluates and decides whether to accept an individual risk on a case-by-case basis. This is different from treaty reinsurance, where the reinsurer covers all risks within a portfolio. Question 21. Under Kentucky law, which of the following would not qualify as an acceptable form of reinsurance collateral? A. Cash held in a Kentucky licensed bank. B. Letters of credit issued by a U.S. bank. C. Corporate bonds rated R or higher. D. Property or real estate owned by the ceding insurer. Answer: D. Property or real estate owned by the ceding insurer. Explanation: Kentucky regulations typically require that collateral be in the form of liquid assets such as cash, letters of credit, or highly rated bonds. Property or real estate owned by the ceding insurer is not generally accepted as collateral for reinsurance. Question 22. Which type of reinsurance agreement allows the ceding insurer to negotiate the terms and conditions of each individual risk with the reinsurer? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Treaty reinsurance. Answer: B. Facultative reinsurance. Explanation: facultative reinsurance is negotiated on a risk-by-risk basis, allowing the ceding insurer to present individual risks to the reinsurer for approval. The reinsurer evaluates and decides whether to accept each specific risk. Question 23. Which of the following is not a factor typically used in determining the premium for reinsurance? A. The type of coverage being provided. B. The loss experience of the ceding insurer. C. The capital and surplus of the reinsurer. D. The operating expenses of the ceding insurer. Answer: D. The operating expenses of the ceding insurer. Explanation: while the type of coverage, loss experience, and financial strength of the reinsurer are key factors in determining reinsurance premiums, the operating expenses of the ceding insurer are typically not considered in the pricing of reinsurance. Question 24. Scenario-based. ABC Insurance, a small insurer in Kentucky, has entered into an excessive loss reinsurance agreement. The reinsurer is obligated to cover 80% of any losses over $500,000 per claim. If ABC Insurance suffers a loss of $1 million on a single claim, how much will the reinsurer pay? A. $400,000. B. $500,000. C. $800,000. D. $1 million. Answer: A. $400,000. Explanation: in an excessive loss reinsurance agreement, the reinsurer covers 80% of losses exceeding the attachment point, which is $500,000 in this case. Therefore, the reinsurer pays 80% of $500,000, which equals $400,000. Question 25. Under Kentucky law, which of the following is a requirement for a reinsurance agreement to be valid? A. The reinsurer must be admitted by the Kentucky Department of Insurance. B. The reinsurance agreement must be in writing and signed by both parties. C. The ceding insurer must obtain approval from the Kentucky Insurance Guarantee Association. D. The reinsurer must agree to cover all potential claims of the ceding insurer. Answer: B. The reinsurance agreement must be in writing and signed by both parties. Explanation: to ensure legal enforceability, reinsurance agreements in Kentucky must be written and signed by both the ceding insurer and the reinsurer. The admission status of the reinsurer and approval from the Insurance Guarantee Association are not necessary for validity. Question 26. Which of the following best describes the role of a reinsurance intermediary? A. The intermediary takes on financial responsibility for claims and premiums. B. The intermediary acts as a middleman facilitating negotiations between insurers and reinsurers. C. The intermediary is responsible for the administration of claims on behalf of the reinsurer. D. The intermediary directly underwrites insurance policies on behalf of the insurer. Answer B. The intermediary acts as a middleman facilitating negotiations between insurers and reinsurers. Explanation. A reinsurance intermediary serves as a middleman helping both insurers and reinsurers to negotiate, place, and manage reinsurance contracts. They do not assume financial risk or administer claims directly. Question 27. Which of the following types of reinsurance is most appropriate for an insurer that seeks to protect itself against catastrophic events? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Stop loss reinsurance. Answer B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is designed to protect insurers against catastrophic losses by covering claims that exceed a specified threshold. It is ideal for insurers that need to mitigate the financial impact of large, rare events. Question 28. Scenario-based. Zai's reinsurers has agreed to a surplus share treaty with an insurer. The treaty provides that Zai's reinsurers will assume 75% of risks above $200,000. An insurer has a loss of $500,000 on a single claim. How much will Zai's reinsurers pay for this claim under the surplus share treaty? A. $200,000. B. $375,000. C. $500,000. D. $150,000. Answer B. $375,000. Explanation. In surplus share reinsurance, Zai's reinsurers assume 75% of losses above $200,000. Therefore, they will pay 75% of the $300,000, the amount above $200,000, which is $225,000. Question 29. Which of the following is a requirement for reinsurers in Kentucky when engaging in non-proportional reinsurance contracts? A. The reinsurer must cover at least 50% of the ceding insurer's total risks. B. The reinsurer must maintain minimum net worth as specified by Kentucky regulations. C. The reinsurer must provide reinsurance on quota share basis. D. The reinsurer must have capacity to absorb high-frequency claims. Answer B. The reinsurer must maintain a minimum net worth as specified by Kentucky regulations. Explanation. Non-proportional reinsurance contracts, such as excessive loss, require that the reinsurer meet Kentucky's regulatory standards, which include maintaining minimum net worth to ensure that the reinsurer has the financial capacity to handle claims. Question 30. A Kentucky insurer is entering into a catastrophe reinsurance agreement with her reinsurer. Under this agreement, the reinsurer will pay for losses above a $10 million threshold. What is the primary purpose of this agreement? A. To provide coverage for small, frequent losses under $10 million. B. To protect the insurer from large, low-frequency losses that exceed $10 million. C. To share the premium income of the insurer with the reinsurer. D. To ensure that the reinsurer accepts all risks from the ceding insurer. Answer B. To protect the insurer from large, low-frequency losses that exceed $10 million. Explanation. A catastrophe reinsurance agreement is designed to provide coverage for high-severity, low-frequency events that result in losses above a set threshold, in this case, $10 million. It helps protect the insurer from the financial impact of catastrophic events like natural disasters.